The active versus passive debate has gone on for years. Some people swear by the low-cost index-based approach to investing, whereas others are willing to pay a higher price to have an active manager hand-pick stocks which they think will outperform the market. Every year, the S&P Dow Indices tries to settle this debate when it releases its SPIVA scorecard. And what this does is it has a look at all the active managers in a space and compares their returns to a relevant benchmark. And over a 5-year period, it turns out that 80% of active managers don't actually outperform their relevant index, which is quite a compelling case for index investing. But of those active managers that do outperform, we also have to consider if they can consistently outperform. In other words, can they continually beat the index over time, or is it more of a fluke? Luckily, the S&P Dow Indices recently released a report which looks into this, and that is what we are going to delve into in today's video. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. So before we jump into the numbers and have a look at the consistency of active performers, let's first of all take a step back and have a look at what benchmark the active performers are actually being pegged against. And for the purpose of this video, I'm Australian, so we're going to have a look at the Australian active managers and their appropriate benchmarks. So this table shows the relevant SPIVA category and the benchmark that it's pegged against. And for me, it seems like a pretty fair matchup. However, one thing I would say is that a number of active fund managers out there wouldn't consider themselves in competition with the chosen benchmark. For instance, if a manager has a mandate to protect capital in a down market, and is willing to hold short positions to do so, then you could argue that pegging him against the S&P ASX 200, for example, is not appropriate. But largely, for me, these matchups make sense. Now let's consider the persistence of funds that outperform their benchmark. Or put in other words, let's have a look at those active fund managers that outperformed in 1 year. Can they continue to beat the index moving forward? And the results are summarised in the following two tables. These two tables show the performance persistence of Australian active fund managers over a consecutive 3-year period and a consecutive 5-year period. So at the start of 2017, 379 fund managers out of a pool of roughly 1,300 funds outperformed their benchmark. After 3 years, only 15.8% continued to outperform their benchmark. This means that from the total pool of 1,300 funds, you have roughly a 4.6% chance of picking an active manager that continues to outperform over 3 consecutive years. Not great odds, but it gets worse. If we extend that time period out to 5 years, only 1.3% of the funds consistently outperform their relevant benchmark. So going back to the total pool of 1,300 funds, you have about a 0.4% chance of picking an active manager that would consistently outperform the benchmark over 5 years. What this data is suggesting is that it's very hard for active fund managers to continually beat the index year on year. There's often going to be years of underperformance. And as an investor, if we're willing to accept years of underperformance, then the next logical thing to consider is, do the best performing fund managers tend to continually rank well against their peers? Let's have a look at that now. If you do pick a winning fund manager, then will that fund manager remain the best place for your money over time? Well, in order to answer this question, the S&P Dow Indices has had a look at the top quartile of fund managers over a 3 and 5 year period to see if they remain the best performers. These two charts show the number of funds in the top quartile and compare their relevant performance over a 3-year consecutive period and a 5-year consecutive period. As you can see from the data, of the active fund managers who are in the top quartile, only 14.1% remain there after 3 years and only 1% remains there after 5 years. What this tells us is that it's very hard for active managers to remain the best of the best. If you think about these numbers logically, they make a lot of sense, right? Because often fund managers have a particular niche or a particular investment style which will perform very well in certain market conditions, but not others. So take Warren Buffett for example. It is widely accepted that Warren Buffett is one of the greatest active fund managers of all time. But let's have a look at his 1 year performance compared to the S&P 500. So as you can see, Warren Buffett has underperformed the S&P 500 over the last year, and quite considerably. But really this comes as no surprise because Warren Buffett is a value investor. And lately, markets have been favouring growth investors. So you wouldn't expect Warren Buffett to change his convictions on what he believes is a good investment simply to try and keep up with the market at every point in time. So there are going to be periods where his investment methodology underperforms, but it doesn't mean he's a bad investor. He's still a very successful investor, and when value investing comes back into play, he will again likely outperform the index. As a retail investor, what this means for you is that picking an active fund manager isn't really a set and forget strategy, because there's a good chance that over time they will start to underperform the relevant index. Now, what I'd suggest you do is come up with your own convictions as to what investment style you want and where you see the market headed, and then pick an active fund manager at that time which suits. After listening to all this, you're probably sitting there and thinking, why would anyone ever invest in an active fund manager? But before you jump to that conclusion, you need to put things into perspective a little bit. Now, all of the figures that we've talked about so far were developed by or put together by the S&P Dow indices, who are basically responsible for developing and maintaining stock indices for investments such as ETFs. Given the roots of this data, we can expect that there's going to be some bias towards painting passive investing in a more favorable light than active investing. And as an example of this, if we go back to the first table that we looked at with the ability for active investors to continually perform over a 3 and 5 year period, if we change those figures and we had a look at the average return over a 3 and 5 year period, then it'll probably paint a slightly different picture. Similarly, just because an active fund manager isn't likely to remain in the top quartile of fund managers over a consecutive 3 and 5 year period, doesn't mean that their average annual return wouldn't consistently beat their peers. So before trusting any data that you look at, just remember that all data needs to be put into context. In my opinion, active management isn't dead. It still has its place in a portfolio, just to a lesser degree than passive management. And now I just want to run you through some of the reasons why I believe this. Firstly, this data is based on a study of roughly 1,300 active fund managers in Australia. However, a large portion of those funds shouldn't be considered active. I've come across countless funds that say they're active, but you look at the underlying holdings and it looks an awful lot like the index, with a few weightings, minor weightings changed here and there. For these funds, of course they're going to underperform because you're getting the same exposure with a higher fee. I would like to see those active managers whose portfolio represents 80% or more of the index be removed from this study. When considering fixed interest positions, the number one focus should be on capital preservation. After all, if you aren't concerned with capital preservation, then just buy equities. I believe that a good active manager can better protect your capital in the fixed interest space than an index-based approach can. Active management allows you to better target specific portfolio outcomes. For instance, if you want more of an income focus, you'll be better placed to use an active listed investment company or LIC than you would a passive exchange traded fund or an ETF. LICs often provide a significantly higher fully franked dividend than a comparable ETF. In the current market, a lot of investors would argue that there are many zombie companies. These are companies that have lost their revenue due to COVID and are hanging on for dear life, being held up only by government support measures. With an index, you're likely to get some exposure to these companies. A good active manager would likely remove these holdings from the portfolio. If you anticipate that a market correction is coming, then sometimes it'll be beneficial to hold active managers in your portfolio who hold the same view as you, because they can either hold cash or short the market as a hedge against a downturn. If you buy an index, it's going to be 100% invested at all times. You just need to strap yourself in for the ride. So all things considered, I typically use a core satellite approach to investing, which uses index funds as the core of the portfolio and then the active managers as the satellite in order to try and achieve that alpha. But that's it for me today, guys. I hope you enjoyed this video. If you did, please leave it a like, and I will see you guys in the next one.